Good evening, dear students. Good evening, everyone. A warm welcome to all of you on this wonderful session organized by ICAI to help you in your preparation for your CA inter exams. And the subject which we are going to begin today, it's a brand new subject for all of you, wherein you have, probably just learned a bit about it, but not in detail. Now, this subject is obviously a new to all of us, all the CA inter students. This is a subject, it's a really interesting subject, and it's going to be like an inspiration to create a career out of it. Okay. So, the subject that we are going to discuss today is financial management. Right. So, the subject that we are going to start today is called as financial management. A really interesting subject in which we are essentially targeting, to learn the basics of finance. Till now, I don't think we have learned anything about finance. It has been more of like, accounting part. Right? We have discussed more of like accounting, wherein we have focused on preparation of the financial statements. Right. So we have never been into that market or into that area where we are looking for post that activity. I mean, after preparation of financial statements, what are we really supposed to do? That is something which we haven't yet discussed, right? So that's what we are going to target over here. So where your bookkeeping and accountancy comes to an end, financial management starts working out of it. I mean, financial management starts after the bookkeeping and accountancy comes to an end. Okay. So I'm pretty sure you might have learned how to pass the journal entries, how to create ledger, how to create a balance sheet and P&L, how to account for the adjustments, right? So all these things are definitely taken care of by you in the subjects, right? Especially the bookkeeping and accountancy. But now we are going to take it ahead into the next level of our understanding called as the financial management. Okay, guys. Now let's just come to the name of the subject. Let's try to decode this name of this subject, and then we can definitely go ahead and start discussing about this subject in detail. So first up, we're going to talk about financial management. So there are two words. So the first word that we have is, of course, finance. And the second word that we have is called as management. Right. So we have this subject has got two important words, which is finance and management. Now let's first focus on management. What do you mean by management, guys? What do you mean by management? Yeah. What do you understand by the word management, guys? Anyone? What do you understand by the word management? Any specific inputs, guys? How do we understand the word management? Yeah. Handling of resources for business enterprise. Okay. Handling of resources for business enterprise. Managing business. Okay. Ideal utilization of resources plus control over them. Okay. Arrangement. Management means arrangement. Okay. Decision making of business to manage the work. Okay. By doing something properly, by planning. Command on people and process. Okay. Then Ishwar is implementing the plan, checking it, controlling it. Okay. These are the functions of management that you are talking of. Now, if you look at what are we really talking of when we are talking of management. As a manager, let's say as a as a HR manager, what is your activity? As a HR manager, what is your activity, guys? As an HR manager, what is your activity? What are you supposed to do? Because I'm just trying to look into the function of management. So if you are a HR manager, human resource manager, what are you supposed to do? Yeah. If you're a human resource manager, what are you supposed to do? Can I say you're going to bring people into the organization? You're going to hire, right? You'll undertake interview. You'll bring the interview, people on board. You'll give them training, right, and then put it into their respective roles, right? That is what as a HR manager you are supposed to do. What are you going to do as a production manager? What are you supposed to do as a production manager, guys? As a production manager, what are we supposed to do? Can say getting the best raw material, getting the best technology, implementing it, and trying to get the best product out of it, right? So if you look at what is the activity of management all about, whenever I say management, what is the activity of management all about? So the first thing that we have is raising of resources, and second is the second word. I mean, the management is raising of resources, and the second is allocation of resources. Raising of resources and allocation of resources. Can I say the HR manager raises the human resource and allocates them? The production manager raises the material and allocates them. Uh, you know, then if you look at finding the right person for the right job, that's your HR manager. Production manager does the same thing. Now, any activity of management you see, it's the same thing. Getting the resources and implementing, I mean, putting those resources into action. That's your task of management. So management is all about raising of resource, that is getting resources into the business and then allocating into the allocation of the resources. So when I say financial management, when I say the word financial management, okay, what do you think? What will be the activity of a finance manager? What will be the activity of a finance manager? What will be the activity of a finance manager? Tell me. Simply, can I say raising of funds and allocation of funds? Raising of funds and allocation of funds, right? This is the activity of the finance manager. Now, any activity which is undertaken, do you think it is going to be without any aim, without any objective, without any goal? Is it going to be like, any activity that you undertake, is it going to be without any active, without any goal, objective? No, right? Of course, there's going to be some sort of objective that we are trying to focus on. We are trying to achieve something, right? So we are essentially interested in knowing what is that objective or what is that goal that we are looking at, right? So how do we go about, uh, you know, looking at that goal or objective? What is the objective of this finance manager? So finance manager does two activities. One is raising of funds, and second is allocation or application of funds. But what is the ultimate goal of the finance manager? What is the ultimate goal of finance manager, guys? What is it that finance manager is having the objective or is really trying to look at? Yeah, what is the objective of finance manager, guys? What do you think? Why is the finance manager doing this? Yeah. What is objective of finance manager? Okay. Let me see the answers. To take care of company's financial health. No. Inflow and outflow of fund. Raising funds at lowest interest. Okay. Obviously, I will be raising funds at lowest cost, you can say. At lowest cost. And of course, allocation of funds at highest rate of return. Right. So we are going to, of course, raise funds at the lowest cost and, of course, allocate the funds at a highest rate of return. But why are we doing this? What is the ultimate objective of this, guys? Yeah. What is the ultimate objective of this? Why are we doing this? What is the ultimate objective of we doing this? Yeah, guys. Anyone? Yeah. 1 second, guys. There is some issue with the video. Just a moment. Yeah, working. Yeah, guys. So what is the ultimate objective? Profit. Okay. One of the uh, objective as I got main aim over here is profit. Okay. So are we looking to maximize profit or are we looking to minimize the profit? Yeah. So you are saying that you want to uh, maximize profit or minimize profit. Of course, you're saying maximization. So aim is profit maximization. Right. So aim is your profit maximization. Okay. Fine. So maximization of profit. But you know what? This profit maximization, is something, it's a age-old concept. Rather, instead of looking at profit maximization, uh, we can say the more accurate thing is, wealth maximization. Wealth maximization. Now, obviously, uh, whose wealth maximization are we looking at? We are obviously looking at shareholders' wealth maximization. Okay. So aim is profit maximization. Aim is obviously not profit maximization, but our objective or main aim is going to be the shareholders' wealth maximization. Okay. Now, what do you really mean by, can you differentiate any sort of idea you have between profit maximization and the wealth maximization? Yeah. Any idea about what is wealth maximization? Wealth maximization relates to the value of the entity. Okay. Wealth maximization is the value of the business entity. Okay. It is for future Okay. Profit is short term, wealth is long term. Okay. Okay. Now, when you say shareholders' wealth maximization, you're looking for uh, increasing the value of shares. That is what we are really talking of. So, finance manager is looking for increasing the value of the shares. So, when we are saying shareholders' wealth maximization, we are looking for increasing the value of the shares. Okay, so aim is profit maximization, and shareholders wealth maximization is something which is obviously a higher precedence, and profit maximization is not that primary motive of a finance manager, which is raising funds at a lower cost and allocation of funds at a uh, at a highest rate of return. This is done with the objective of wealth maximization, shareholders wealth maximization, that is increasing the value of the shares. Always remember the finance manager is going to you know always remember the finance manager is always going to uh, work in such a way that ultimately the wealth of the shareholder should increase. Ultimately the wealth of shareholder should be increasing. Okay, now let's have a quick look at what are the chapters that we are going to cover when we are looking at this subject of financial management. Now, one part of the function, as I said, raising of funds, and the other part, as I said, allocation of funds. Okay, so raising of funds and allocation of funds. Now, raising of funds, we have got certain chapters which will be, targeting it. So raising of funds is from where we are going to raise the funds, guys, right? That's what we are looking at. So funds can be raised from multiple sources, right? So the chapter that we are going to deal with the raising of funds is sources of funds. Okay. So raising of funds, they are going to say that the first chapter that we're going to deal with, obviously, which we are going to deal today is sources of funds. And scope and objectives is what we are covering right now. Scope and objectives of finance management, and then sources of funds. Now, how do we decide? Like for example, what are the different sources of funds that you can think of? Can you name few sources of funds for the time being, guys? Can you name a few sources of funds for the time being? Can you name a few sources of funds? Yeah, sources of funds. From where can you get the funds? Debt, equity shares, bank loan, okay, debentures, okay. Then equity shares, debentures, then overdraft. Okay. So these are the various sources of funds that you have knowledge of right now. Now, you tell me, how are you going to decide where you are going to get the funds? You know that there are multiple sources of funds, but then how are you going to decide where to get the funds? How are you going to decide which source of fund you are going to follow? How are we going to decide that? Like whether to take a bank loan or go for overdraft or go for maybe issue of debentures. Can I say whichever is cheaper? Whichever is cheaper, or I need to calculate the cost of capital, right? Yes, I need to calculate the cost of capital, right? So scope and objectives of financial. That's the first chapter. Second is sources of funds. Now we have multiple sources of funds. Out of those multiple sources of funds, from where are we going to raise the fund? That's going to be covered by the topic of cost of capital, right? So I need to calculate the cost of capital. Now, once I've identified cost of capital, can I only raise funds from the capital which is having the lowest cost? Yeah, just a moment, guys. Yeah, yeah. So raising of funds, we were looking into the part where is scope and objectives, then sources of finance, and the cost of capital. Now let's say we are looking at multiple costs of capital, right? So cost of capital is definitely going to be different for different types of capital. So if suppose we have the lowest cost coming from the bank, can we simply raise funds only by way of bank loan, guys? Can we only raise the funds by way of bank loan? Let's say bank is offering us a good rate of interest, and can we have a company formed only with the help of bank loan? There's no share capital, nothing. Is it going to happen like that? No. So we need bank loan. I mean, we need the uh, something what we call as a combination, right? A combination of capital, right? A combination of different sources of funds. We need not have it only equity or only debt, right? We need not have only equity or only debt. We are going to have a combination. So that ratio, that proportion of debt and equity is what we call as the capital structure, right? So proportion of debt and equity is what we call it as a capital structure. So raising of funds, when we are raising of funds, we are obviously looking for the lowest cost funds, but we are not going to focus only on that low cost fund. Rather, we are going to have a combination of debt and equity. Okay, we are going to have a combination of debt and equity. And the combination of debt and equity is simply what we are going to talk of as a capital structure. Okay, combination of debt and equity is what we're going to talk as capital structure. How much equity, how much debt, that is what we are going to discuss, right? And which is the best for the company, which will lead to ultimate objective of we achieving the highest share price. So how do we have that a proper balance? That's what we call as a capital structure. Okay, so we can say these are the four things where we are going to look at how to which are the areas from where to raise the funds, right? Now what are we going to do with this money that we have raised? What are we going to do with the money that we have raised? Yeah, what are we going to do with the money that we have raised? The money that we have raised, what are we going to do with that? We're going to invest, right? So think from the point of view of a balance sheet of a company. Which are the uh, areas where you can be investing your money? Think from a business point of view. You can invest in two areas. One is you can acquire long-term assets. Okay, one is you can acquire a long-term asset, which means the asset is going to be there in the business. The asset is going to be there in the business with you for a longer tenure, right? So the business, it's going to be there in the business for a longer tenure. And the business which we are talking of, like you can have a long-term asset like a plant, a machinery, maybe a computer, maybe a furniture. So long-term asset, maybe we can have invest in a new project. So these are long-term investments, right? Or else you can be investing into current assets, basically keeping some stock, keeping some cash, right? So that's your allocation of funds. So in allocation of funds to deal with the decisions, wherein we want to check, uh, whether, I mean, if we want to check what is the status of, or whether we should be investing in a particular long-term asset or not. For that, we have a chapter called as investment decisions. We have a chapter called as investment decisions. Same way, we have a chapter called as working capital management. So we have a chapter called as investment decision and working capital management. So allocation of funds, we can have investment decisions or working capital management. Okay. So these are the two areas where you can put your money. Apart from that, if you have got money, you have got a decision to make whether to uh, pay dividend or not to pay dividend. Acha, payment of equity dividend, is it mandatory for the company, guys? Payment of equity dividend, is it mandatory for the company? Payment of dividend, is it mandatory for the company? Of course, no, it's not a mandatory thing. So can I say it's voluntary. It's something, company has to decide or company has to take a call whether to invest or not to invest. Company has to take a call whether to invest or not to invest, guys. Right? So how do we decide whether the company should be investing or company should not be investing? Right? Whether the company should be paying dividend or not paying dividend. Because that decision, when you pay dividend, when you don't pay dividend, that is definitely going to have an impact on the value of the company. That's definitely going to have an impact on the value of the company. So how do we take that call, whether to pay dividend, whether to pay equity dividend or not dividend? That is what is going to be covered, in this topic called as dividend decisions. Right? It's going to be into the dividend decisions. Right? So whether to pay dividend or not, that's going to be decided in this chapter called as dividend decisions. Now, these are the chapters that we have. One set of chapters looking at the raising of funds, and another set of chapter called as the allocation of funds. One set of chapters looking at the raising of funds, and another set called as the allocation of funds. Now, once we have identified these set chapters, there is another set of chapters called as analysis of financial statements. So we have few chapters which are going to be looking for analysis of financial statements. So analysis of financial statements, we have one chapter called as ratio analysis and another called as leverages. So once the financial statements have been prepared, how do we go about analyzing it? Once the financial statements have been prepared, how do we go about analyzing it? And that's what we are going to calculate as a ratio analysis. Okay, so ratio analysis of financial statements, we can say one part is ratio analysis, another part is the leverages. Right? So this is a whole set of financial management subject syllabus, guys. This is what we are going to cover in this entire CA intersection. Okay. Fine, guys. So this is what is the syllabus for CA Inter, and this is what we are essentially going to discuss or talk about when it comes to the financial management as a subject. These are the topics that we are going to target. Okay. Now, let's come to more discussion on to raising of funds is done. Then we have said that our objective is to maximize the shareholders' wealth. Now, when we want to maximize the shareholders' wealth, we need definitely have a high value of shares. High value. We need to maximize the value of the company. Now, value of a company, guys, it's a function. It depends on how you are funding your business, how you are investing the money that you have raised, and how much dividend you are paying. So value of a company, remember, it's going to be a function of investing, financing, and dividend. Now, if you look at what is the scope of financial management as a subject, what is the scope that we have? First up, we need to determine the size and the rate of growth of enterprise. Right? So you need to determine what is the size and what is the rate of growth that you're targeting for in case of enterprise. Determine the composition of assets. Okay, determine the composition of assets. Determine the debt equity mix. Okay, so you need to check what should be the debt equity mix. That's what the capital structure that we have discussed. And also analyze, plan, control, and the financial affairs of the management. So this is what your scope of the finance manager is. Okay, size and determine the rate of growth. What should be the composition of asset? How much fixed asset? How much floating assets or current assets should be there? What should be the debt equity mix? How do we go about planning, analyzing, and controlling the financial affairs of the enterprise? Now, objective of finance manager, as we have discussed, it's about profit maximization or wealth maximization. Of course, the transition is happening from profit maximization to wealth maximization. Let us just discuss a bit of more about it. Okay, what's the difference between them? First up, when you say profit, it simply means income is excess of income over expenses. So when you want to look for profit maximization, we essentially want to increase the level of income and we want to reduce the level of expenses. Right, guys? So when we're looking at profit maximization, essentially what we are targeting is that to increase the level of income and decrease the level of expenses. So profit maximization simply means increasing income and decreasing the expenses. That's your profit maximization. Okay. So higher profit means higher income and higher expense. But the definition of wealth is a bit different. Definition of wealth is going to be a bit different. Wealth is simply going to be present value, the current value of benefit that you're going to get in future. For that, what expense or what cost you're going to put in. Okay, for that, what cost or what expense you're going to put in, that's your wealth part. Okay, so let me just give you an example. Let me just give you an example. So as I said, profit is just, revenue minus expenses. And wealth simply means, as I said, present value of benefits minus present value of costs. So present value of benefits minus present value of costs. So profit is revenue minus expense and wealth is present value of benefits minus present value of costs. Okay. Harsh, don't worry, I'll be uploading this file. This file I'll be uploading, don't worry. So profit is going to be revenue minus expense and wealth is present value of benefit minus present value of cost. So let us look at a case. Case 1. One contract to produce a product. One contract to produce a product. So let's say over here, the revenue is 2000 and the cost for this is, let's say, 800. So we obviously say that profit is going to be difference between these two, which is 1200. So obviously our objective will be to increase this revenue and decrease this cost. But remember, profit is what you're going to earn, only once. You earn profit on transaction. You earn profit on one-time transaction. You make a sale, you get a profit out of it. Is it something, if you're trying to increase the revenue or reduce the cost over here, does it guarantee you a continuous, continuous income or continuous profit happening even in future? If in one of the transactions you're able to generate a higher profit by charging a higher price or maybe by reducing the cost, right? So, is it something which is going to guarantee you that even in future you're going to have a higher profit? No, we can't say that, right? But on the other hand, when you look at wealth maximization, you will say we're looking at present value of benefit minus present value of cost. Rather, I will say, let us take a second case wherein we are setting up a project. Set up a project which has a cost or which has a investment, which has a cost or a investment of, let's say, 1000. And this is going to generate a cash profit every time of 200. So every year, or let's say investment is 800 and you're going to have a cash profit of 100. So now you have got two choices, whether to make an investment of this 100 for setting up a project or to make an investment of 800 to produce a product, right? To produce a product which will be sold for 2000, right? So which one are we really going to look at? Which one are we going to, really take up the decision as? Are we going to invest 800 to produce a product which will be sold for 2000 and you get a profit of 1200, or to use that 800 to setting up a project which will give you a cash profit of 2000, of cash profit of 200 every year till perpetuity? So second case, you're setting up a project, maybe setting up a subsidiary or a new plant or a new factory, where you're going to invest 800. And that plant or factory is going to give you 200 cash profit every year. So what will you prefer? Making a one-time profit of 1200, or setting up a business which is going to give you cash profit of 200 every year? Remember, this cash profit of 200 is for every year. Right? So obviously, I'll simply say, what is the wealth that we are generating here? Wealth is equal to present value of 200 per annum minus 800. Present value of 200 per annum minus 800, that is your wealth. So wealth of the project is going to be present value of 200 per annum minus 800. Now, for the time being, I'm just giving you an idea. Let's say present value of perpetuity. I'm just giving you this formula, just accept this as it is. This is going to be cash flow divided by rate. So I can definitely say that this is 200 and the rate is what I'm assuming it to be, let's say 10%, 8%. So the present value of wealth is going to be 200 divided by 8% and then minus 800. So this is 200 divided by 8% minus 800, which is 1700. This is the wealth that we have, which is 1700. So by investing 800, you'll be getting a wealth of 1700, right? You'll be getting a wealth of 1700. And of course, if I take this, let's say, let's just say this is 5%. That's 3200. So now, obviously, long-term project is going to have a more wealth, and this 3200 value or worth is going to be there with you for a long period. So when you're looking at wealth maximization, we are essentially looking at keeping something called as a permanent or a continuous cash flow coming in, not like one-time investment and you get some benefit out of it. Okay. So when you're saying profit, it's going to be income minus expense, but wealth maximization means it's present value of benefit minus present value of cost. And this is something which is permanent. The term profit is generally said to be vague. It is said to be vague. Okay, you say that income minus expense, but whenever you're computing profit, it's subject to a lot of assumptions. It is subject to a lot of estimations, right? Do you think that if same line of business is being done, everything is same, the two companies are going to have same profit? Need not be. Because one of the companies may be following straight line method of charging depreciation. Another company may be following WDV method of charging depreciation. Right, guys? Possible? Yes or no? One of the companies may be following straight line method. Another company may be following WDV method. Right? The way you are valuing your inventory, FIFO basis or weighted average, that's also going to change your profits. Right? The way you are following the fixed asset accounting, that may also change your profit. So profit is something, it's a vague number and it may be a subjective, right? Profit maximization never takes into account the risk that we have undertaken when we are taking up a project. That is never considered in this profit maximization aspect. And remember, this profit maximization term, it's a very narrow term, guys. It's a very short term. It's a very narrow-minded term. And then cash flow approach. When we are looking at wealth maximization, we are looking at essentially, cash flow approach and not accounting profit. Now, why cash flow approach is more appropriate and more correct as compared to the accounting profit. Let me just give you an example for that. Let us say we start a business. Okay. Let us say we start a business. Okay. We have this profit and loss account and the balance sheet. So as we start a business, of course, the capital is invested. Let's say 10,000, and you've got a cash balance of 10,000. Now, suppose you made a purchase. You made a purchase of 10 lakh rupees. Where are we going to have that entry as? Where are we going to have that entry? Purchase. Can I say it will be the amount of creditors? So creditors 10 lakh, and we have purchases of 10 lakh. Then sales value. Let's say you sold these goods. Okay. Suppose you sold these goods for 12 lakh. So of course, the next impact is going to be on the debtors. 12 lakh, right? And of course, we make a profit of how much? What is the profit that we have made? 12 lakh minus 10 lakh, which is 2 lakh. And this will be shown as a P&L account or as a balance. And then if you look at the balance sheet, it is obviously tallying at 12 lakh 10,000, right guys? So the balance sheet tallies. Balance sheet tallies at 12 lakh 10,000. Now the question is, if I take this balance sheet and P&L to a banker, and I'm just asking the banker to provide a loan against this particular business. I'm just asking the banker to provide a loan against this particular business. Will the banker give me any loan? Will you as a banker provide me any loan against this business? Will you as a banker give me any amount of loan against this business? Yeah? No. Why? Because there is no cash flow happening in this business. Sir. The cash which was 10,000, it has remained constant. There is no inflow. There's no money coming from debtors. You have not paid anything to the creditors. So of course, this particular profit of 2 lakh, it's not a cash profit, it's just a book entry. And therefore, we are saying that cash flow approach is more accurate as compared to your accounting profits. Okay. Now, how do we ensure that what is your objective? When you want to look for profit, you're looking for profit maximization, looking for highest amount of profit. Now, of course, when your objective is wealth maximization, you will be looking for highest market value of the shares. Profit maximization, it's a short-term thing. Wealth maximization is a long-term aspect. In profit maximization, you don't consider risk, whereas in wealth maximization, you definitely pay attention to the risk that you're undertaking. In case of profit maximization, time value of money is not considered. But in case of wealth maximization, we do consider the time value of money. Over here, profit maximization requires immediate resources, but in wealth maximization, it's a gradual and consistent performance that is need to be looked at. Profit maximization is definitely easy to achieve, but wealth maximization is something which is difficult to achieve. Okay. Now, in finance, we have a very simple rule that if you want to earn a higher return, you need to be undertaking higher risk, right? So, for example, we have two cases. Let's say we have a State Bank of India and a cooperative bank. Of course, the rate of interest that's offered in the State Bank, that's lower because the risk is lower. But whereas if you're investing in a cooperative bank, the return is also going to be a bit higher, right? So simple fundamental is high risk will definitely be required for high return. Okay. So for example, let us say One second. Yeah. Um, Let us say we have three investment opportunities. One is a State Bank of India FD. Okay. Um, Another is, let's say, ICICI Bank FD. Another is, let's say, debenture of company. And let's say one more, uh, equity share, or say debenture of TCS, or equity share of TCS. So SBI FD, State Bank, ICICI Bank FD, debenture of TCS, or equity share of TCS. If the State Bank of India FD is giving you 6% return, how much return do you expect in ICICI Bank FD? How much return do you expect in ICICI Bank FD? A bit higher than that, maybe let's say 7%. What about debenture of TCS? What about debenture of TCS? Should be, can it's a bit higher? Maybe I'll talk of 9%. And we're investing in equity shares. What's the rate of return you would be expecting? Yeah. What's the rate of return that you'll be expecting? Obviously higher, maybe 14%, right? So the simple fundamental is high risk will require higher return. High risk will require higher return. Right, guys? Yeah. Now, when we are looking at a joint stock company, which is a public limited company, a joint stock company, uh, it's a, let's say it's a public limited company. There's a problem with that. And the problem is that in case of a joint stock company, there's a separation of ownership and management. There's a separation of ownership and management. Right? There's a separation of ownership and management. Who are the owners of the company? The shareholders. And who are the managers? The board of directors. I hope you're aware of board of directors, right, guys? You're aware of board of directors? Yes? You're aware of board. Board of directors. Are we aware about board of directors, guys? Yes. So who are these board of directors, by the way, guys? Who are these board of directors? Okay, directors are responsible to take decision on behalf of company. Okay. Okay, so we have other answers. Person who is responsible for the company management. Okay. Okay, then other answers. Then what is the other answer? Okay, so these managers. Okay, so objectives, we say managers are responsible for managing the joint stock company. Okay, whereas the owners are the persons who are owning the business, right? Yeah. So owners are the persons who are going to have the ownership of the company, who are having the shares with them. Okay, so objective wise, we can say on one side we have manager, who is the board of directors going to manage the joint stock company. Owners are the persons who are going to own the company. Now, who is going to bear the risk, guys? Who is going to bear the risk? Of course, the owners. It is the owners who are going to bear the risk, or who are going to take the risk of the company. And they're going to take the risk because of the decisions of the manager. Because of decisions of the manager. Now, of course, manager's income or salary is fixed, which is depends on the profits, right? So, manager's salary is, salary depends on the profit, and that is fixed. That is not dependent on how the company is, essentially performing in a short run. Maybe in a long run, it will affect them, but by that time, they may obviously change the company, right? So the owners are the risk takers, and it's the action of the manager. It is the action of the manager which is going to determine how much risk the owner should be undertaking. Right? It is the manager who is going to decide about where to invest, how much to invest, and what should be the time period for investment. All those decisions are going to be taken by manager. But the problem is the manager is going to decide as an employee, not like an owner. So, do you think there will be conflict between decisions that a manager would be taking and that an owner would be expecting to take? Do you think there's going to be a conflict? Yes or no? Do you think there's going to be a conflict between the decision that manager would be taking and the decision which, as a shareholder, you would want to take? There's likely to be a conflict, right? So manager would obviously you know look for the projects, will look for the projects uh, where risk is not optimal, right? Or the owners may be ready to take a higher amount of risk. Manager may not be ready to take the higher amount of risk. Or it's quite possible that manager will be of that opinion that let me just invest in any damn project because any project is going to provide us returns. Right? Manager would be definitely saying that let me invest in any damn project because any project is going to provide us with a good amount of return. Right? So any project is going to provide us with a good amount of return, and let's take high risk, but that high risk may not be acceptable to owners. Now, why are managers motivated to take higher risk which may not be explainable, which are not accurate, which may not be explainable? Right? So why are we in a position to give manager uh, that chance? So the manager that we are manager is something, the profit, I mean the income is not dependent on the profit. So he will be obviously motivated to take higher amount of risk, whereas the owner may not be ready to take that greater amount of risk because his capital is at stake. Right. So there's like this conflict which is going to happen. So how are we going to resolve this conflict? The best way to resolve this conflict is to make the managers like a owner. Make the managers like a owner. You can simply say that, look, Mr. Manager, your salary is going to be dependent on the profits of the company. So as the profits increases, your salary is also going to increase. So, or you can say your salary is going to dependent on the share price of the company. If the share price of the company increases, your salary is going to increase. So you're actually trying to link the salary to the share price. So if you're going to link the salary to the share price, guys, if you're going to link the salary to the share price, okay, if you're going to link the salary to the share price, of course, that is going to make manager think like an owner. Like suppose if I take a decision and it doesn't work out to be good, and ultimately if I'm going to lose out of it, my salary is going to fall. So now he will start thinking like a owner. Or maybe you can give them compensation which is linked to profits partially and to the long term results also. Like you can say that whatever your salary you're getting, that plus you will get some portion of profit, and also the certain shares you can give, like your ESOP. You can give employee stock option plan, or give them motivation by way of giving them options to giving them shares of the company, right? So when you have this sort of conflict, the best way to resolve this conflict is to link the profits and long-term performance with their salaries. So automatically that will result in higher, that's going to result in a better management or better coordination between the owners and the managers. Okay. Are we clear till now, everyone? Are we good till now? Are we good till now, everyone? Yeah. Okay. So that was about the first part, which we are talking of the scope and objectives of the financial management, right? So we have seen how do we look at the wealth maximization or profit maximization, and what should we be looking at, when we are having there's a conflict between agency or between the owners and the managers. So that is what we have covered till now. So right now, let's do one thing. Let's just take a break, guys. Post break, we will be discussing on the sources of finance, for which I have prepared this uh, really colorful and attractive chart. We are going to discuss a lot of things in this chart. So let's just take a break right now. At the post break, we will be targeting the sources of funds chapter. Okay, guys. So let's take a break, guys. Okay, welcome back, guys, after the break. Okay, so let's get started with the next part of our today's discussion, which is looking into the various sources of funds. What are the various sources of funds? Broadly, if you look over here, sources of funds can be categorized into two areas. One is the owned funds, and another is the borrowed funds. So on one side we have the owned funds, and on the other side we have the borrowed funds. Right. So, anyways, broad classification of any type of fund you can take. It's going to be either a owned fund or either a borrowed fund. Okay. So you have owned funds or borrowed funds. Now, coming to this part, which is owned funds. Owned funds, we can have either money is raised by way of money is raised from the domestic markets or from the international market. Okay, domestic market, we can have broadly three categories: external sources or internal sources. So in case of external, we have got the equity share capital and the preference share capital. Okay, so equity share capital and preference share capital. Now, how do we go about looking at these two sources of funds, equity share capital and preference share capital? Remember, equity share capital is a permanent capital. So when you say permanent capital, there's no obligation on the company to repay the equity share capital. Each equity share is representing the ownership of the company, right? Always remember, being an equity shareholder, you will be getting a residual interest in income and assets. Now, what do you understand by the term residual interest in income and assets? Yeah, guys, what do you understand by residual interest in income and assets? What do you mean by residual interest? Residual interest means after payment of all other things, whatever is left out is going to be given to the equity shareholders. Like when it comes to income, you pay salary, you pay interest, you pay taxes, and rest all, I mean, you pay preference dividend. Whatever is left over is given to the equity shareholders. Therefore, this you have the residual interest in the income as well as in the assets, because when the company goes for liquidation, the money that is realized, when the company goes into liquidation, the money that is realized from sale of assets is going to be distributed to the equity shareholder at the end. And that will be the last thing which will be given to the equity shareholder. Equity share capital, always remember, has got the highest cost of capital. Because of all the sources of fund, equity shares are having highest cost, highest risk. Now, of course, as an equity shareholder, do you expect a high rate of return or do you expect a low rate of return? Of course, we will be expecting a very high rate of return from our equity share investment, right? We'll be obviously expecting a high rate of return during our investment rate. So, because of that higher expected rate of return, we want a higher, because of higher rate of return, we want a higher, because of higher risk, we want a higher rate of return. And obviously, we asking for a higher rate of return, it means the company is under an obligation to provide a highest return to us. So that's actually a highest cost for capital. So that's the highest cost of capital. Now, of course, it is having a security to other fund providers. Now, what is a security to other fund providers? Let me just help you understand this with the help of an example. Let's say you have equity share capital, you have reserves and loan. And then you have maybe the assets. So assets are worth 1,000. Equity share capital is, let's say, 400. Reserves are 400 and loan is 200. And let's say we have another company which is having capital structure as 200, 300 and 500. Now, out of these two companies, suppose these two companies need an additional funding, additional loan of, let's say, 200 crores. These two companies need an additional loan of 200 crores. And these two companies need an additional loan of 200 crores. So how do we go about managing it? I mean, which company would easily get the money? Yeah. Which company would easily get the money? The first one or the second one? Which company would easily get the money or loan? Yeah, guys. Of course, the first one because it is having. Of course, the first one because it's having a lesser amount of you know debt, or I can say the proportion of equity is higher. The proportion of equity is higher over here, right? So since the proportion of equity is higher over here, we will be definitely expecting easy for raising money over here. So having higher equity, it provides security to other fund providers because having a higher equity will make it easier for you to raise money. Right? It will make it easier for you to raise money because it will be like a safety because already the investors are having a huge amount of investments. Right? The owners are having a good amount of investment, so we can definitely expect a higher rate of return. Hmm. So that's what we were looking at this statement. As I said, it is a security to other fund providers. In terms of advantages, it's a permanent and irredeemable capital. There's no obligation for you to repay the money. It increases the financial base and also helps to facilitate additional borrowing. There's no obligation to pay dividend, and you can obviously raise additional money by way of rights issue also. Now, the disadvantage is that dividend income that you receive, that's a taxable for the shareholder. Of course, the investment in this is risky investment. If you keep on issuing more and more equity shares, if you keep on issuing more and more equity shares, what's going to happen ultimately, guys? If you're going to issue more and more equity shares, can I say the number of equity shares will increase? So earnings per share is going to fall, right? So I can say like this. Let's say you had a profit of 1 lakh, and you had number of equity shares as 5,000. So what will be earnings per share? What will be the amount of earnings per share? On a per share basis, how much are we earning? If our profit is 1 lakh, and number of equity shares is 5,000. What will be the earnings per share? Yeah, guys. What will be the earnings per share? Can I say it will be 1 lakh divided by 5,000, which is 20. So earnings per share is 20. Now, if you keep on issuing more and more shares and your profit remains same, let's say you have issued more number of shares and you're now having, uh, 8,000 shares. So with this 8,000 shares, now your EPS is going to be 12.5, right? So your EPS is going to be 12.5. So if your profit is 1 lakh and your number of equity shares is 8,000, earnings per share is going to be 12.5. So can I say there is a reduction in the EPS? Okay, so there's a reduction in EPS. So dilution of ownership is reduction in EPS is happening. And if you're issuing more and more equity shares, you will have more number of shareholders coming in. So the original owners of the company will be having a lesser voting power. Original owners of the company will be having lesser voting power. Right, so lesser control will be there. Right, so that's a disadvantage of equity shares. Now coming to the preference shares. Coming to preference share, guys. So preference shares, these are a hybrid form of investment. Now, what do you mean by hybrid form? What do you mean by hybrid form? It means it's having a feature like debt and also like equity. So like debt, they are going to have a fixed rate of dividend, right? So like debt, they're going to have a fixed rate of dividend, and like equity, uh, the dividend is payable only if you have profit, right? So this is a hybrid form of financing. The rate of dividend is definitely going to be higher than the rate of interest because the risk in preference share is more than the debenture. Uh, these shares are cumulative. It can be cumulative, non-cumulative, redeemable, participating, non-participating, or convertible even. Now, what do you mean by cumulative and non-cumulative shares? Cumulative, non-cumulative preference shares. Are we aware, guys? What are cumulative preference shares and non-cumulative preference shares? What are cumulative preference shares and non-cumulative preference shares? Yeah. So it means that if it's a cumulative share, it means if in a particular you don't have any profit, then of course you won't be paying any dividend. But in future years, when you are going to have profit, you need to pay dividend. And that's your cumulative shares. Non-cumulative means if current year you don't have profit, it doesn't get accumulated. Redeemable, participating, non-participating means participating in additional profits, in superior profits when you have super profits coming in. So part of that super profit, uh, a part of that super profit is going to be attributed to these things. Okay, it will be given to the preference shareholders. So these are participant. Convertible means the preference shares getting converted to equity shares. Now the advantage over here is when you issue preference shares, there is no dilution in EPS happening. You get an advantage of leverage. Leverage means taking money which is, raising funds from those areas where there is a fixed rate of return. There's no risk of takeover happening because if you're issuing preference shares, getting more and more preference shares doesn't give you a pure ownership. Rather, you'll not be able to take over the company. Dividends are prefixed and decided. They're redeemed after a specified date. Disadvantage is like preference dividend, something which is not tax deductible for the company. So company has to pay full tax. And also there are the cumulative preference dividend. So you have a dividend which are it's a disadvantage that even though it is a sort of dividend nature, but it keeps on accumulating. Okay. Okay. Then internal. So internal we can say uh, this is a profit which is earned by the company, but it has not been paid. It's a profit which is uh, you know it's a profit which is accumulated profit which is not paid by the company as dividend. Right? So accumulated profits flowed by the company back into the business. It belongs to the ordinary shareholders and increases the net worth basically. Okay. Right. So that's your internal or retained earnings, which is, the funds are raised. Chats is visible definitely, Navneet. Okay, so accumulated profits, the retained earnings are the accumulated profits that are flowed by the company back into the business, belongs to the ordinary shareholders, and also increases the net worth. This is like the company has earned profit, but it has not paid out as dividend. So this is like a easy available fund, source of fund available with us. Now let's go to the international sources of owned funds, wherein we have GDR, ADR, and IDR. Okay, so let's understand this with the help of an example, the global depository receipt. Okay. Now, let's say we have an Indian company called as the Infosys Limited. Can the Indian company directly go to any global market? Can the Indian company just go to any global market and get its shares listed on their exchange? For that case, let's say US market. Can it go to the US market and simply get the shares listed on the US stock exchange? Will the investors of US understand what is this Infosys share? Will they understand what is this Infosys share? Are they going to understand the denomination? No, because for them, Infosys is not a legally recognized company because it is incorporated in India. Right? So there is no legal backing which Infosys is having for its depository, for its shares. So it's always not at all possible for each and every company to explore the overseas market directly. So they'll have to go through something called as a depository. Do we know what is a depository, guys? Do we know what is a depository? Yeah. What's a depository, guys? What is a depository? Anyone? Okay, just like we have banks to keep money, we have got banks to keep money. Same way we have got depository to keep the shares of the company. Just like we have banks to keep money, same way we have depositories to keep shares of the company. We know that shares are no more traded in physical form. They are traded in what form, guys? Shares are traded nowadays in which format? Dematerialized form, right? So when you say dematerialized form, it's a electronic format. It's an electronic format. So electronic format, how are we going to store the shares? The shares are stored at an entity called as a depository. So depository simply it's a bank of shares. Depository simply meaning it's a bank of shares. So when you say bank of shares, shares are going to be kept with the depository because it is going to act like a banker form. Just like we have a deposit in India, we will be definitely having depository in US also. So what this Infosys Limited will do is it will take, let's say, 10,000 shares. It will approach the depository of US and it will say, please take these shares, undertake the checking or background check, whatever you want, and please issue shares to us. I mean, please accept these shares and against these shares, issue depository receipts in the market. So depository will take these 10,000 shares and it will issue 100 depository receipt. And one depository receipt is going to be counted as 100 shares. One depository receipt is going to be counted as 100 shares. So one depository receipt equal to 100 shares. That's going to give us, that's what we are going to invest in the US market. Okay, so depository, we can say dollar. So we have like, this 100 depository receipts are issued in the US market. Investors are now going to buy these depository receipts. Why are investors going to buy these depository receipts now? For a simple reason, guys. Now the instrument is issued by their organization. Instrument is issued by an organization of their country. They are definitely going to recognize that. And against that, they're going to provide dollars. Now, of course, depository is going to pass on that dollars to India through RBI, and Infosys is going to get rupee value. Right. So these are like a indirect listing of the shares. Depository receipts are indirect listing of the shares. Right. Now, obviously, as the company pays dividend, the depository holders are also going to get the dividend. Right. The depository holders are also going to accept the you're going to get the dividends also. So this is like a way you are going to raise the money. So when you have the depository receipts issued in US market, you're going to talk it as a uh, American depository receipts. Whereas when you're going to invest it in what you say, when you're going to invest in any other country, it's going to be called as a global depository receipts. Okay, so many Indian companies have obviously have their American depository receipt listed. So you can have like Wipro, MTNL, Deutsche Bank, State Bank of India, ITC, ICAI. All these companies are having their depository receipts listed in the US market. Okay, now let us go for the borrowed funds category, guys. Even in borrowed funds, we can see there are two broad discussions that we can have. One is the domestic category, and other is the international category. Let's first go into the domestic category, guys. Domestic funds, domestic sources of funds. So, in domestic sources of funds, we have something called as seed capital. Do we know what a startup is? Do we know what is a startup, guys? And do you know what's a startup? Startup is basically a new business with a new idea, right? So, these startups definitely need money for their initial phases. They definitely need money for their initial phases. So when they are needing money for their initial phases, how do they raise money? Like suppose if you are a startup owner and you want to, raise money, how do you get that money, guys? How do you raise that money? Yeah. From where can you get the money as a startup? As a startup, from where can you get the money? Tell me. From where can you get the money, guys? Bank loan? No, 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 no. When you are just a startup, you're just having an idea. You will not get money from bank. Banker will definitely ask for mortgage. You don't have anything to mortgage. So you just have an idea and you want to get money for getting the business. So you will definitely look for getting something called as seed capital. So seed capital is, it is provided by IDBI. So it's an interest free, but carries a service charge of 1%. So remember, because even if you take a loan, you will not be able to service it. Even if you take a loan, will you be able to service it? Of course not. You will not be able to service it because you will not be able to service it for a simple fact, guys. Because you don't have the cash flow coming in, right? You don't have a cash flow with which you want to, with which you can essentially, pay the loan or interest. You don't have that facility. So obviously, you would love to have an interest-free loan, but they say that there is a service charge of 1% for the first 5 years. So remember, for the first 5 years, you just have to pay a service charge of 1%. And then, of course, after that, an increased rate of return you have to pay. And the rate of interest charge depends on the reaping capacity with a moratorium of up to 5 years. Right? So it depends, rate of interest charge depends on the reaping capacity with a moratorium of up to 5 years. So up to 5 years means up to 5 years, no interest is payable. Beyond that, any interest or share of profit is going to be paid. Okay, so this is like a startup fund. It's a fund provided to the startup entities where they don't have the capacity to pay interest and all, but they provide like a service fee based small amount by which they can at least try to commercialize their ideas. Okay. Then we have something called as zero coupon bond, right? Or deep discount bond, right? So let's understand this as a zero coupon bond or as a debenture. Do we know what's a debenture is, guys? Do we know what is a debenture? Do we know what is a debenture? Servicing of debt. Servicing of debt, Pranav, means payment of its loan, I mean interest and principal on time. Okay, okay. So debenture or bond, it's a type of debt investment, right? Right. So debenture or bond. So debenture or bond, we can say uh, these are like, as an investor or as an entity, from the company's point of view, let's say XYZ company issues debentures, for rupees 100 at an interest rate of, let's say, 12%. So what is the cash flow that we are going to have? Can I say in year zero, today, we are receiving 100, first year, second year, third year, fourth year, fifth year, let's say for 5 years, every year you are going to pay an interest of 12. And finally, you pay 112 at the end of its tenure. Right? This is what typically happens. Right? What if I tell you that we have a debenture where you invest 100 today, you don't get anything during the 4 years, and in the fifth year, you are going to repay the 100. Will you find any investor for this type of debenture? Will you find any investor for this type of debenture, guys? आधा घंटा आधा घंटा 8:30. Yeah. Will you find any debenture for this type of interest? This type investor for this type of investment? Of course not, because I'm giving 100 and I'm getting just 100 back in return. So what's the interest am I earning, right? So any company, any company which is offering this type of debenture is not going to find any investor, because as an investor I need some rate of return. Here there is no rate of return which I'm earning. There's a rate of return which I'm earning, and therefore this is not something which is attractive. Now, so obviously, what we can really think of in this case is, uh, the company says that we don't want any, payment obligation in 4 years. We don't want any payment obligations in 4 years. So obviously, the investor will say, do one thing. We are going to give you maybe, let's say, 60 today, and you return us back 100, which is the face value. Now, do you think there is going to be some investor for this? Do you think there's going to be, you'll find some sort of investor for this? Yes. Now it makes sense, sir, because if I'm going to invest 60 and I'll be getting like 100 back, if I'm going to invest 60 and I'm going to get 100 back, then obviously it makes sense. Now you will find a lot of investors. Right? So this investor, I mean, this sort of debenture is what we call it as a zero coupon bond. It means there is no coupon, there is no interest every year which is paid, but a discounted bond. So zero coupon bond is issued at discount and redeemed at par. So zero coupon bond is issued at discount and it is redeemed at par. So zero coupon bond is going to be issued at discount and it is going to be redeemed at par, guys. Okay, everyone. So that's what we are talking of as a zero coupon bond here. Okay. Now we have secured premium notes. The secured premium notes are redeemable notes along with detachable warrant. Warrants need to be converted within time period notified by the company. Do you know what is a warrant? Do you know what is a warrant, guys? Do you know what is a warrant? Anyone? No? Don't think of an arrest warrant. We're not talking of that arrest warrant. Okay, warrants are basically, it's a document. Warrants are basically a document, which gives the holder a power to buy shares at a pre-specified price. At a pre-specified price. So when you're issuing these debentures, it's a normal debenture, but debenture along with debenture you have a attached warrant to it, and if you just remove that warrant, and take it to the company separately, the company will give you shares against that, and this is supposed to be done within 4 to 7 years. Okay, you can also have unsecured loans, which is provided by the promoters or the owners of the company, right? So these are the long-term part. Now, short-term sources of funds, you can take a loan from commercial banks. You can have a floating rate bond also. Floating rate bonds, which are generally the loans that we are raising from the market. Generally, the loans that we are raising from the market, they carry a fixed rate of interest, right, guys? Generally, the rate of interest carrying a fixed rate of interest. But it's also quite possible that your rate of interest is floating in nature. Right? It's quite possible that rate of interest is floating in nature. So when you say floating in nature, these are the bonds where the rate of interest will change as per the market situations. These are the bonds which are, the which is going to change as per the market situation. Okay. So it's like, let's say loan at 8% rate of interest. Okay. So let's say if the principal is 10,000, you have like year and interest. So year 1, 2, 3, 4. So interest will be every year 800. And let's say if you have loan at not 8% rate of interest, not at 8% rate of interest, but loan at rate of interest of RBI repo plus 5%. So as the RBI repo changes, the rate of interest that is charged to us is also going to change. So let's say we have year and the repo rate, and then we'll say the interest, or we'll talk of rate of interest, and then we'll say what is the amount of interest. So year 1, 2, 3, 4. So repo, let's say first year repo was 4%. What will be the rate of interest then? If the repo is 4%, what will be the rate of interest? If the repo is 4%, what will be the rate of interest? Yeah, guys. If the repo is 4%, what will be the rate of interest? Can I say it's going to be 4% plus 5%, which is, so interest is going to be 900. Next time the repo becomes 4.5. Next time the repo becomes 4.5. So that's 4.5%. Right? So the rate of interest is going to be now 4.5% plus 5%. So interest will be 950. Okay. So now let's say the rate of interest is now 3.8. Repo is, let's say, 3.8. So the rate of interest is going to be 3.8 plus 5%, which is 8.8%. So now the interest will be 880. So we observe that every time, we thought that every time we are going to have a, uh, rate, every time you have this rate of interest over here, you can say the rate as the repo changes, the rate of interest is also going to change. So this is a type of floating rate of interest. This is a type of floating rate loan. Okay. Okay. So that's your floating rate. You can get a fixed rate or you get a floating rate. Debentures is what we have discussed. Acha, inflation bond. This is something new thing. Inflation bond. Uh, in fixed rate of interest, as the rate of interest changes, rate of interest, as the inflation changes, there is no change happening with the rate of interest. Okay. So now as an investor, if you want to protect your investor, if you want to protect your investors from inflation, you would like to have your rate of return also changing according to the inflation. So these are the bonds in which interest is adjusted for inflation. For example, interest rate is 11% and inflation is 5%, investor is going to earn 16%. Thereby the investor is protected against inflation. Then you have zero interest fully convertible debenture. So these are like compulsorily and automatically converted after a specified period of time. So this is like a convertible debenture on which no interest is paid, but it will get automatically converted to equity shares, right? Then the other sources of funds could be, commercial papers. So commercial papers are the documents which are issued by the highly rated corporates, good rated, highly, you know, uh, good corporates who are, what do you say? One second, guys. Yeah, so good rated companies who are having a good amount of, you know, goodwill in the market. Okay. So that's your commercial paper. T-bills are the bonds which are issued by the uh, yeah, T-bills are the bond which are issued by the government for raising of funds. And of course, certificate of deposit are these are the deposits, these are the documents which are issued by the banks for raising money. Similarly, public can also issue deposits, public deposits or debentures. It could be like one company investing in another company also, which is an intercorporate deposit, right? Then overdraft is something which we know. Overdraft is a banker facility which facilitates you to draw money over and above the balance that you have. Cash credit is again a sort of overdraft facility. Uh, hmm. So over and above the cash balance, you can definitely raise some money from the bank. That's your overdraft facility. Clean overdraft is an unsecured overdraft which is granted only to the financially sound entities. Cash credit is again similar to overdraft facility, but you can withdraw that money only to the extent of your requirement. And I mean, the interest will be also charged to you only on the amount of that you have withdrawn. Bill discounting is again a type of funding that you can have. International sources, you can get money from development banks like your Exim Bank or Asian Development Bank. Then you have Euro convertible. This is like it's providing an option to the holder to convert bonds into equity shares. It may be a callable or puttable. Callable means the company can redeem the bond before maturity, or investor can redeem the bond before maturity. Then you have external commercial borrowings. Certain international commercial banks also provide you loan. Euro bonds are the instrument which are denominated currency of the country in which they are issued. For example, a rupee note, a debenture which is issued in rupee terms in US is what we call as a euro bond. Same way, a dollar bond issued in Japan, that will be called also as a euro bond. And the name of these bonds are, basically a bit different aspect also. There are certain specific bonds that we can say Yankee bond. These are the bonds which are issued in USA, but this is issued by non-US banks and corporations. So this is issued by non-US banks and corporation, and the currency in which it is issued is obviously the dollar. Same way, any non-Japanese company wants to raise money from the Japanese market, it can issue so by issuing called as a samurai bonds. Same way, bulldog bonds also you can have, which are issued in UK by a non-UK company. Now, important aspect over here that we would like to discuss again is something called as a securitization, guys. So let me just help you with this concept of securitization, guys. Just think of a banker. Let's think of a State Bank of India. It has got loans and advances, right? It has got some loans and advances. That's your major asset. Now, would State Bank have given loan to one single entity or multiple entities and multiple investors? Of course, multiple investors, right? So let's say State Bank has already given, let's say, home loan worth 1,000 crores to a lot of people, and it is earning a interest of 9%. It is earning an interest of 9%. Now, this entire 1,000 crore, is this entire 1,000 crore, it's going to be, this entire 1,000 crore is something, that is, just tied up by the bank, right? So this entire 1,000 crore is just blocked by the bank in the loan. It cannot utilize that money now. So now the company is essentially looking at some way by which it can maybe try to get it sorted. Maybe some way by which the company wants to essentially get away with this 1,000 crores. So what it does, it creates a special entity called as a special purpose vehicle. So what it will do is it will simply transfer. This is going to simply transfer the SPV. I mean, transfer this entire loan to SPV, and it will get a lump sum money from the SPV. So SPV is going to provide you with a lump sum money. Okay, SPV is going to provide you with a lump sum money, and that lump sum money will be used by the SBI to carry on the other businesses. Now, how is that SPV getting this lump sum money of, let's say, 1,000 crore? Let's say the home loan portfolio is worth 1,000 crore, but SPV is going to provide you, let's say, 990 crores only. Suppose SPV is going to provide you only 990 crores, right? So if the SPV is providing 990 crores, of course, 10 crore is a deduction for maybe bad debts happening or provision for something. How is this SPV getting this 990 crores? So what SPV will do, it will approach public. It will approach the public and ask for the public that, see, we are going to take over the home loan of SBI. We are going to earn interest out of it. And whatever interest we are going to earn, we are going to pass it on to you as an investor. So you have the public at large. You're going to issue them bonds, which are called as the mortgage-backed securities. They are called as the mortgage-backed securities. Bonds are issued to the public. Public is going to give, let's say, 990 crores to the SPV, right? You may issue 9.9 crore bonds of rupees 100 each. Now, the idea is from home loan, SBI was earning, let's say, 9%. SBI will pass, let's say, 8.5% to SPV now, keeping 0.5% commission. And SPV may keep a margin of 1% and then pass it on to the public. So public will be offered a rate of interest of 7.5% instead of what they would have got as 6%. Instead of what they would have got as 6%, now the public is going to get a higher rate of return. So the public at large is having a higher rate of return at a lower cost, right? Sorry, a higher rate of return on their investment. They will definitely be ready to do that, right? So this process where your home loan is getting, converted to a liquid asset is what we call it as a securitization process. Okay, so this is what we call it as a securitization process. Okay, so in this securitization process, the home loans are getting converted to securities. Home loans are simply getting converted to some other sort of securities. Okay, fine. This is your securitization process. Then there is something called as leasing. Leasing is also a source of finance. Do we know what leasing is, everyone? Are you aware what is leasing? Are you aware what is leasing? Are you aware what is leasing? Yeah. Do you know what is leasing all about? Yeah. Taking on rent. Okay. Taking on rent. Okay. Anything else? Operating and finance lease. Okay. There are two types of leases. Fine. AS19. Okay. Taking on rent. Okay. So we've got two types of leases. One is a finance lease and operating lease. Finance lease is basically like becoming you're not a owner, but you're very close to becoming a owner. So risk and reward is passed to the lessee. There is obsolescence, which is risk of obsolescence borne by the lessee. There is, lease is cancelable. There's a repairs and maintenance and operations are, there's a cost of repairs and maintenance operation that is borne by lessee. And over here, the lease is actually full payout. That is a single lease pay. Single lease repays the cost of asset together with interest. Whereas operating lease is like a short-term thing, right? You can have a sales and leaseback arrangement. Now, what is sales and leaseback arrangement? It means I have a asset right now. I have an asset right now, but I need funds. So what I'll do is I'll simply transfer that asset. I'll simply transfer that asset to someone, right? So I'm going to simply transfer that asset to someone, and what I'm going to get essentially is, I'm going to transfer that asset to someone, and I'll sell it, and then get it leased back to me. I'll simply sell it, and then get it leased back to me again. Okay, so that's your sales and lease back we are essentially talking of. Okay, so it facilitates you to get a liquidity sort of thing, right? You get a liquidity sort of thing where you are able to use that asset, and also you are able to uh, what we say, we're able to use that asset, and we can also uh, essentially what do you say, get money out of that asset, right? So you'll get a lump sum payment, against you just have to pay the fixed lease payments, right? So these are the lease financing activity. Now, we do have something called as venture capital and export finance also. I'll be definitely uploading this file on the portal, and you can definitely have a look at it. Right now, let me just stop the discussion over here, and let us just go ahead with some MCQs, guys. Okay, we'll just take up certain MCQs to be discussed in the class. I'll just share the screen. Wait for the MCQ. Okay. Fine. So I think now you can see the screen. Are the questions visible, guys? Are the questions visible? Okay. Fine, guys. So first question, which of the following is not one of the major finance decision? Investment decision, financing decision, dividend decision, marketing decision. Which is the correct answer? Which is the correct answer, guys? Of course, it's a marketing decision, right? It's the marketing decision. Primary objective of wealth maximization is. So, what's the primary objective of wealth maximization? Primary objective of wealth maximization, guys. Maximize short-term accounting profit, maximize the market value of the firm shares, minimize the cost of goods sold, maximize the number of employees. Of course, B is maximize the market value of the firm shares. Profit maximization as an objective is limited because it ignores risk and timing of return, always ensures long-term survival is only measure of financial success, fully accounts for social responsibility. Of course not. So it's limited because it just ignores the risk and the timing of the cash flows. Financial distress occurs when sales revenue exceeds cost. Of course, no. Cash inflows are inadequate to meet the current obligation. Uh, Firm has high fixed assets. Firm declares high dividend. Now, when do you say that financial distress is there, guys? When do you say that there is a financial distress? Okay. So the financial distress occurs when cash inflows are inadequate to meet current obligations. The agency problem arises due to shareholders managers having identical goals? No. Managers acting in the best interest of shareholders? No. Separation of ownership and managers? Yes. So there's a segregation of owners and managers. It is due to that agency problem arises. Absence of debt in the capital structure? No, that's not the case. So agency problem arises because of the separation of ownership and management. Okay, let's look at this another set of questions. Look at these 5 questions, guys. Or initial 3, then we'll come to the fourth part. Look at first 3 questions. Okay, so which of the following is classified as a long-term source of finance? Trade credit, debentures, commercial paper, accrued expense. Of course, these are the debentures. What is the key feature of preference share compared to equity shares? Preference shares are voting right? No. Preference shares receive dividend before equity shares? Yes. Preference shares are not redeemable? No, they are definitely redeemable. Preference shares are always convertible? No, not always. Option B is correct. Which of the following is a characteristic of debt securitization? It involves direct sale of individual loans. It converts illiquid assets to marketable securities. It is only used for equity finance. It's not recognized. No, of course, it's able to convert the illiquid assets into marketable securities. Okay. Look at the fourth and fifth one. Which of the following is a short-term source of finance? Short-term source of finance, trade credit. Because taking goods on credit, buying goods on credit, it's going to provide a short-term source of finance. Then, what is the primary purpose of bridge finance? To provide short-term funding until long-term funds are dispersed. The name itself is bridge. Right, guys? Yeah. Okay. So I think we are through with the MCQs. Yeah. So I hope you are able to answer the MCQs appropriately, right? And now if you have any queries, you can just ask it, or else we can just call it a day then. I'll be definitely uploading these file on the portal, guys, so you can definitely access it from there. No need to worry. This entire file will be there on the portal. Okay. So any queries, guys? Or else we can just call it a day if there are no queries. First and second chapter, how many marks? There's no specification of marks, guys, in CA exams. Please take a note of it. Okay, so everything clear? Fine. Then let's just call it a day. See you in the next class, guys. Probably we are meeting again on Thursday with a new topic called as the ratio analysis. Okay. Bye-bye, guys. Good night. Enjoy. Take care. Done. Yep. Good night.